2026 Outlook for Residential Mortgages in the United States. The residential mortgage market in the United States is poised for a significant transition in 2026, shifting from a period of stagnation to one of anticipated, albeit moderate, recovery. The consensus among major forecasters suggests that a slight easing of mortgage interest rates will be the primary catalyst for increased activity, ultimately driving a rebound in home sales and a surge in refinancing volume, citing Fannie Mae and the National Association of Realtors. Specifically, Fannie Mae projects the 30-year fixed-rate mortgage will average 6.2% in the first quarter of 2026, before declining to 5.9% by year-end, which should unlock pent-up buyer demand that has been contained by higher rates in previous years, citing Fannie Mae. This modest decline, however, will not see a return to the historic lows of the pandemic era, as rates remain influenced by broader economic factors like inflation, Treasury yields, and the Federal Reserve's monetary policy decisions, citing the National Association of Realtors. A key area of divergence among industry forecasters is the expected pace of recovery in home sales. The National Association of Realtors anticipates a substantial rebound, projected at 14% surge in existing home sales in 2026, citing stabilizing rates, steady job growth, and significant underlying demographic demand, particularly from millennials. Conversely, Fannie Mae's Economic and Strategic Research Group has a more cautious outlook, forecasting a more modest 7.3% increase in home sales. This disparity highlights the fundamental uncertainty regarding how quickly rate improvements and limited, though improving, inventory will translate into closed purchase transactions, especially as first-time buyers continue to face extreme affordability pressures, citing both Fannie Mae and the National Association of Realtors. While purchase activity is expected to rise, the strongest growth in the mortgage sector is projected to come from refinancing volume, with average rates forecast to drift lower towards the 6% range. Many existing homeowners who secured mortgages at higher rates are expected to seize the opportunity to refinance. Fannie Mae projects the share of single-family mortgage originations commanded by refinancing activity will surge to 36% in 2026, a notable jump from 26% in 2025. This shift means that while the purchase market will show signs of life, a significant portion of the origination industry's focus and volume will be driven by existing homeowners seeking to optimize their debt, signaling a market in transition where rate-conscious financial activity takes precedence. Crucially, the persistent challenge of affordability will continue to shape the residential mortgage landscape. Home price appreciation is expected to moderate compared to recent years, with Fannie Mae projecting a sharp deceleration of 1.3% growth, though the National Association of Realtors maintains a slightly higher 4% forecast, supported by chronic housing shortages and robust job creation. Furthermore, the increase in the conventional loan limit for 2026 to $832,750 in most of the U.S. will provide some relief by making conventional financing available to a wider pool of buyers as home prices rise. Despite these factors, the market remains bifurcated, with cash buyers and repeat buyers holding a distinct advantage over the first-time buyers, who are disproportionately affected by high prices, rising debt, and a lack of entry-level inventory. We welcome you to subscribe to our YouTube channel for additional home mortgage and financing videos. Thank you.